And it's an honor now to sign this incredible bill and get our country working again. Thank you very much.
Hello and welcome. You're watching the Global Reset from the CNBC-TV18 Prime Ionic Wealth Angel One studios. I'm Prashant Nair. Well, the biggest global headline, of course, those visuals doing the talking. After 43 days of what has been the longest standing federal government shutdown in U.S. history, President Donald Trump signing a funding bill passed by both the Senate and the House of the U.S. Congress, the measure which will fund U.S. government operations through the end of January. Remember, the House of Representatives passed it earlier in a vote which was 229 in favor, 209 against. All but 6 Democrats voted against the bill. The Office of Management and Budget told federal employees to return to their jobs on Thursday. However, the full impact of the 43-day-long closures is still expected to affect Americans for weeks. According to the Bipartisan Policy Center, 670,000 government workers were furloughed during the shutdown. Another 730,000 were required to continue working without pay. Now that the shutdown is over, they can expect to receive checks in the coming days, and those who weren't working can go back to the office. Minutes before signing the funding bill, Trump said, and I quote, "Democrats tried to extort our country. Republicans never wanted a shutdown," he said. The president, who was flanked by Republican leaders of the Congress.
For the past 43 days, Democrats in Congress shut down the government of the United States in an attempt to extort American taxpayers for hundreds of billions of dollars for illegal aliens and people that came into our country illegally. From gangs, from prisons, from mental institutions. They wanted to pay them $1.5 trillion, which would have really hurt our healthcare businesses and our recipients at levels never seen before. Today, we're sending a clear message that we will never give in to extortion, because that's what it was. Many of these unions and non-unions. Over the past 7 weeks, the Democrats shut down this cost the country $1.5 trillion, this little excursion that they took us on. Republicans never wanted a shutdown and voted 15 times for a clean continuation of funding.
Well, 2 Federal Reserve officials have expressed opposition to another interest rate cut at the central bank's next meeting in December. What has further muddied the outlook for the Fed's next steps are remarks by Susan Collins, president of the Federal Reserve Bank of Boston, and Rachel Bostic, president of the Atlanta Fed. Rachel Bostic is one of the most hawkish members of the Fed, suggesting that a central bank's rate-setting committee could be tilting against what had been expected to be a 3rd straight interest rate cut in December. Now, amidst all of this, Rachel Bostic has in fact also announced his retirement at the end of his term in February next year. An expected departure amid a push by Trump for more influence over the Fed. Here's a report.
Atlanta Federal Reserve President Raphael Bostic said on Wednesday that he will retire at the end of his term in February. The first Black and openly gay person to lead one of the Fed's 12 regional banks is leaving unexpectedly amid a push by President Donald Trump for more influence over the U.S. central bank. Trump does not select the presidents of the regional Fed banks, but the appointments must be approved by the central bank's board of governors, which the U.S. president is trying to reshape. Trump is attempting to fire Fed Governor Lisa Cook, and his Treasury Secretary is vetting candidates to replace Fed Chair Jerome Powell when his term ends next spring. Kevin Nicholson, Global Fixed Income Chief Investment Officer at Riverfront Investment Group, says he isn't concerned about a long-term politicization of the organization.
I think at the end of the day, most of the folks at the Fed wants the Fed to remain independent. So regardless, I think the institution will win out in the long run. That, the true economists that are at the Fed, they're going to want to, continue to have that independence.
Trump has railed against Jerome Powell and says the Fed is being too cautious and slow in cutting rates. Bostic said on Wednesday that he believes labor market conditions do not warrant another interest rate reduction as inflation remains too high. All three Fed governors appointed by Trump have explicitly backed further rate cuts, with calls for especially steep reductions from Stephen Myron, who was previously an economic advisor in the Trump administration. A search committee will be formed to select Bostic's replacement.
Okay, well, meanwhile, the White House has said that it was unlikely that key federal inflation and labor reports, which are impacted by the government shutdown, would be released. White House Press Secretary Karen Leavitt on Wednesday said, and I quote, "The Democrats have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released." I think the September numbers will be released next week. But the October numbers perhaps won't be released. So the next data point in terms of the NFP, etc., is only in December. Well, Leavitt expressed concern that the lack of data is leaving our policymakers and the Fed flying blind at a critical period. Okay, let me just welcome in our guest now. Arend K Kapteyn is Global Head of Economic Research at UBS, and he's with me to take some questions. Arend, great to have you with us here. Thanks very much for joining us on CNBC-TV18 Prime. Let's just start with the latest and what I referred to, which is the end of the government shutdown. How do you read it, Arend? I mean, it's not as if it's hurt, at least not financial markets in any meaningful way. So the end of the shutdown, will it help?
Well, we're going to get a barrage of data now. So yes, it'll help because we'll get the data, but the data is all going to come basically in pretty quick succession. So we'll have to sort of digest that, and I think the market's quite nervous about what exactly we're going to get, because we have had a bit of a blackout period. I mean, economically, because they've actually, as part of the deal, agreed to pay the furloughed workers and effectively not lay anybody off. It really shouldn't have a big impact. We were calculating about a 1.5 basis point cost per day of the shutdown, but you do tend to get most of that back once the government reopens. So I don't think it's going to make too big a dent on basically GDP for this quarter.
Yeah, got that. This is a broader question, but staying with the theme, are we sort of, in a way, in that big, beautiful bill, the cuts to healthcare spending, etc., Arend, are we likely to sort of see the Trump administration going a little soft now, especially after some of the electoral setbacks in New York and elsewhere? Is there a change in trajectory which we should expect?
Well, it's not clear, right? So this is a strange shutdown because actually I think there is bipartisan support to extend the ACA subsidies, which is basically what they were arguing over. And the important thing, though, is that the president does not seem to support that. He's said he wants to, he's going to roll out his own alternative healthcare proposal, which then makes it harder for, I think, the members of Congress to have some kind of bipartisan agreement with the Democrats that they would extend those subsidies. But that was really what the whole thing was about. That do we agree to these ACA subsidies as a condition for reopening the government, or do we only get a promise of a vote? And so that's basically what's been agreed, to get a promise of a vote. And I don't think it's generally perceived that it was the Republicans who sort of backed down. It was a very small cohort of Democrats who basically broke ranks, and they decided to then vote along with the Republicans, and only in exchange for this vote, not for an actual agreement on the subsidies, which I think are still in doubt. So I don't think anything's really changed in terms of sort of the substance of what was in the big beautiful bill and what they are likely to do next year. I think if you sort of think about what happened in the recent election last week, there is sort of now I think an attempt by the White House to come up with a few new things to, I think, neutralize or offset some of the unpopularity of the big beautiful bill, because of course they've tried to portray that as stimulus. It's not that obvious that that's how it's perceived, and so they've now rolled out this new proposal about $2,000 stimulus checks. It doesn't look to me like there is congressional support for that. So there's a lot of spin, I think, going on what's in this bill that they just signed and what was in the One Big Beautiful Bill Act. But so I don't think anything has fundamentally shifted.
Treasury Secretary Scott Bessent's comments last night on how Treasury auctions must remain regular, predictable to maintain investor confidence, market stability. The size of issuances will be adjusted gradually to avoid market disruptions. How does one read it? I mean, are these significant, or what's your sense?
Well, that's very helpful. So we have had a few moments the last few years where there was a surprise at the when they basically announced when they on a quarterly basis sort of announced what the issuance is going to be. We're very relaxed about the issuance outlook. So if you look at sort of 2026, we don't think we sort of talk about 10-year equivalent supply duration. So if you look at the duration supply to the market, it's not going to be fundamentally higher next year than it is this year. We also have the Federal Reserve likely restarting a Treasury purchase program because they need to increase reserves in the system. That could be $500 billion a year. Then we have stablecoin demand, which could be another $500 billion a year. So you have the ability for the Treasury to really issue a lot of T-bills. And so if they can do that, they can push out the coupon issuance and take some pressure off the market. So that's actually, for us, a key support going into next year. And it actually poses, I think, risk for I think the majority of the market, which is sort of in steepening mode. So they think that with fiscal pressures, the direction of travel is that these curves get steeper and steeper. We're not so sure, because I just don't think there's a lot of supply at the back end.
Okay. So in that case, now let's get, Arend, some of your forecasts, right, for 2026. Run us through your global growth forecast, and if you can, I mean, how are they changed as compared to where 2025 is? Global growth, I mean, U.S. growth, emerging market growth, maybe a view on the 10-year.
Sure.
What your assessment of the dollar is? Just the big headline numbers.
Sure. So global growth on a Q4 basis should accelerate maybe a tenth or two. So we're looking at something like 3.3% in 2026. It's very confusing because on a 12-month basis, it looks like the numbers are going down, but that just has to do with the distribution of the growth across the quarters. I think the big picture is that we're in the middle of a soft patch, which is still tariff transmission. It's going to last another 4 or 5 months. And then by the time we get to the end of Q1, that should be over. And then really we think the global economy is poised to accelerate. And so that's because of the cuts we've already had from the central bank. We're seeing confidence has already improved. The global credit impulse is getting better. Real wage growth holding up, and hopefully the uncertainty goes down, because what we implicitly in our forecasts have a period of calm where there's no renewed tariff escalation. So we'll have to sort of see. But so provided we sort of effectively go back to a trend-like growth rate next year, it's sort of a boring year from a forecasting perspective, because we have the 10-year Treasury roughly at current levels by the end of next year, about 4%. We have euro dollar. So you think about FX through a euro dollar lens at about 114 end of next year, so a little bit stronger than where it is. We think the rotation trade is basically sort of over, and then really and credit is basically flat, because credit's already super tight and doesn't really get any tighter next year. So where all the upside is in our mind is in equities. So we have the S&P up about 10% next year, 7,500 target on S&P. We have emerging markets up about 8, Europe up about 8, gold up about 7. So it's sort of as outlooks go, this is one where there's actually not a lot of movement in the forecast, and there's a lot of stability, but we'll see. We've had a lot of shocks this year, and I'm sure we'll have some more next year.
When you say by the end of the first quarter 2026, things perhaps should enter the calm phase and maybe things start to accelerate in growth, tariffs are going to be higher, much higher. Average U.S. tariffs are much higher than what they were a year ago, right? And they will stay there now. I mean, things are getting settled, and hopefully here with India as well, we perhaps will have some settlement not so far into the future. But but when you say things will accelerate, I mean, that's on the back of certainty and interest rate cuts because tariffs are higher.
Yeah, so the way we think about the tariffs, it's a level effect. So the judgment to make is, so you get these tariffs, and then there's going to be an export effect for the world, and so we're seeing that now. So from roughly the August data onwards, we're seeing a very sharp slowdown now in global exports to the U.S. It took a long time, but it's now really in the data, but that's going to, that's just sort of the demand by the U.S. importers adjusting to this new price level, this new tariff level. And then once they have adjusted to the level, then the growth rate from that new level basically just resumes. And it will not be that different from what it was prior to the tariff level, except that the overall amount of goods they're importing has gone down. And so the judgment to make is how long does that last? And so we think that is sort of a 6-month process. So if exports started adjusting in August, and by the time you get to the end of the first quarter, that really should be mostly over. And then on the U.S. side, the transmission is to the consumers. And so far, we've not seen a lot of that. So it's been absorbed by the margins. But we think that rotation is also now starting to happen. So we're looking at average, core CPI prints in the US of about 30 basis points for the next 5 months. And so that is basically a real income shock. So that erodes real income in the US, purchasing power. That pulls down demand, it then further weakens the labor market. But again, that transmission should be over by roughly end of the first quarter going into the second quarter. And so these are level changes that are disruptive. And so we do think this is a bit of a dangerous moment in some sense for, I think, particularly the US economy, given how weak the labor market already is, but it's not everlasting. And so the judgment is how long does it last? And then by the time you get to the second quarter, those effects are behind you, provided, as you say, that there are no new tariffs, right? Because we have seen a tendency to constantly bring back the tariff instrument. So provided there's some calm and certainty, then I think we could start to see growth broaden out. Because right now, it looks like the US in particular is just one big bet on AI. Like there's basically nothing else happening. And everything else is weak.
By the way, this is just a very helpful there. This big debate about AI and how AI is hiding a lot of problems in the US economy. And I mean, we can only see the shine because of the AI. You obviously disagree, right? I mean, it's not just.
Oh, I agree. No, I think it is all AI right now. So in the following sense, so all of the investment acceleration in the US is basically tech capex.
Yeah.
The other investment sectors are all effectively in recession. On the consumption side, although it's harder to have precise numbers there, we think it's disproportionately spending by the upper 20% who happen to own 80% of financial assets. And if you just take the equity portion of their portfolio, it went up by 28% of GDP last year, right? So even if you have small, spending out of wealth coefficients, that's given a meaningful sort of support to consumption. And so you could argue that basically a large part of the consumption strength and all of the investment strength is all basically coming from 9 technology companies, because there's only 9 of them that are sort of driving all this. So I think that helps explain a lot, because if that's how narrow growth is, right? You have all of the sectors ex-tech sort of very pessimistic. They're very uncertain. They don't know what demand looks like. They're not investing. CapEx intentions are at 20-year lows. And then on the consumption side, you have distress across basically the bottom half of the income distribution. We see unemployment expectations basically at recessionary levels. That then explains why the labor market can be so weak while headline GDP is actually pretty strong, right? And there's a disconnect there, which we think has to do with the distribution or the narrowness of U.S. growth.
Okay, all right. We'll leave it there. Really great conversation, and I hope you come back and we're able to do this more often, Arend. Thank you for joining us right now. Okay, well, I think what we're going to do is take a quick commercial break here. We're going to come back and we get you excerpts of our conversation with UBS India's Miki Doshi, a sort of voice, a face you rarely hear from. At least I haven't in the last couple of years. So that conversation up next.